If you're interested in buying a home, but you're not sure how much you can afford, well, today I'm going to discuss debt to income, what it is, why it's important, and how to calculate it so you have a general idea of how much you can afford to spend on monthly mortgage payments. Hi everyone, I'm Courtney Thornell. Buyers often start the home buying process either overestimating how much they can afford, underestimating, or they have no clue, which is fine, but that's why I want to help show you how to get a little closer towards figuring out what you can afford to spend every month on a home. Lenders look at debt to income, also known as DTI, to determine how much of a mortgage you can afford. Now, today we're going to be doing a little math, I know, but hopefully it's not too complicated, and I'll be showing you step by step, so feel free to screenshot or take notes. All right, debt to income is taking all of your current debt and dividing it by your monthly income. So let's break it down and look at the debt first. The lender is going to look at all of your liabilities or debt that's reported on your credit report. This includes things like a car payment, credit cards, student loan payments, if you have alimony or child support payments, any loans you may have co-signed on, if you currently own a home and are planning on keeping it because you are purchasing a second home or investment property, or because you are buying another house and will be using your current one as a rental. All of these payments will be included in your debt. All right, I want to go back real quick to student loans because this could be a little tricky when it comes to factoring this into your monthly debt. If you're already set up on a payment plan, maybe an income-based repayment plan, and your monthly payment amount is reported on your credit report, great, that's easy. We'll use that number. Now, if repayment has been deferred, then we need to figure out what amount the lender will use towards your monthly debt. If you're considering an FHA loan, then the lender will factor in 0.5% of the balance as your monthly repayment. Let's say you have $50,000 in student loans for FHA. The lender will take $50,000 times 0.5%, in which case they would use $250 for your monthly debt on the loan. If you're considering a conventional loan, the lender will factor either 0.5% or 1% as the repayment, depending on if it's a Freddie Mac or Fannie Mae loan, and we'll discuss what those are in another video. So if we figured 1% for the repayment, that would be $50,000 times 1%, which will give you $500 per month for the payment. A VA loan will do calculations a little differently. They calculate each loan at a rate of 5% of the outstanding balance, and then they divide that by 12 months. So it would be $50,000 times 5%, which equals $2,500, and then you divide that number by 12. So $2,500 divided by 12 would be a monthly payment of $208.33. All right, the lender will use the minimum monthly payment that is being reported towards your monthly debt total. If you have a balance of $30,000 on a car and your car payment is $700 per month, the lender will use the $700 to count towards your monthly liabilities. Okay, so let's say that you do have a car payment of $700 per month and a credit card payment where the minimum monthly payment is $80 and another credit card where the minimum monthly payment is $45. And let's say you also have a student loan balance of $40,000, but the payments are deferred, so there's no monthly minimum payment being reported on your credit report. Let's say you're getting an FHA loan. We would take the $40,000 times 0.5%, which would give us a monthly payment of $200. We would take the $700 car payment and the two credit card payments of $80 and $45 and the $200 student loan payment, and add them up. That would bring our total monthly liabilities or debt to $1,025. Lenders will look at your gross monthly income when calculating your income. If you are W-2 salaried employee, great, that's easy to figure out your income. If you're W-2 but also receive an annual bonus or commission, we would need a 2-year history of that income. And the lender would take the average of the 2 most recent years divided by 12 months to calculate what monthly amount would be added to the monthly salary. If the most recent year was less than the previous year, the lender would only use the most recent year's bonus or commission and then divide that by 12 months and use that towards your income. We may also need to get a written verification of employment from your employer, verifying the bonus or commission income and the possibility of continuance. Okay, if you're hourly and work 40 hours a week, the lender will use the amount you make per week times 52 weeks in a year, and then divide that by 12 months to get your monthly income. If you work overtime, that could be a little trickier. You will need to have a 2-year history of overtime, and the lender will take the average over the last 2 years or average the most recent year if the amount of overtime is less than the previous year. We then will also most likely need a written verification of employment from your employer to verify that overtime income. If you have a second job, you need to have a 2-year history in order to use that income towards qualifying. If you don't have a 2-year history, you can still use the funds that you earned from that job towards your home purchase, but the lender won't be able to count that income towards qualifying you for a higher loan amount. If you're self-employed, we will need to see 2 years tax returns. We will need to review those because we may be able to add back in some of your incomes from some of your write-offs that you reported on your tax returns. If you receive child support or alimony, the lender will be able to use this income if you have documentation that shows you have 3-year continuance of receiving that income. So let's say you're a W-2 employee and make $6,500 per month. The lender will use your gross income, that's before taxes, Social Security, Medicare, and whatnot, get deducted from your paycheck. Now, to calculate your current debt to income ratio, you would take the $1,025 that we previously calculated in monthly liabilities divided by $6,500 gross monthly income. That would give your current debt to income ratio of 0.157 or 15.77%. Lenders typically like to see your debt to income ratio at or below 43%, but on occasion will go up to 50 or 55% for certain loan programs if you have compensating factors. Now, if we take the 43% and subtract our current loan to value ratio of 15.77%, that leaves us with 27.23% remaining for monthly housing expenses. To get a dollar figure on that, you would take $6,500 and multiply it by 27.23%, which gives you $1,769.95 for housing expenses. Another way to calculate this would be to take your $6,500 in income times 43%. This gives you $2,795. Take that and subtract your current monthly debt of $1,025. And that gives you the same result of about $1,770 per month towards your housing expenses. Now, one thing you need to remember is that housing expenses aren't just your principal and interest payment on the loan. Your housing expenses that are also included in your debt to income are property taxes, homeowners insurance, possible mortgage insurance, and homeowners association dues. Those all need to be factored into your monthly housing expense portion of your debt to income ratio. Now, just because you're qualified for a certain amount doesn't mean you need to go to the max. You might not feel comfortable paying that amount you are pre-approved for, and that's a conversation we need to have. We want to work with you to stay within your budget. Another reason I suggest not taking your budget all the way to the max, especially if you can get pre-approved at 50% debt to income ratio, is because you should leave some room in your budget in case your property taxes or homeowners insurance or HOA dues increase in the next year. Properties in fire zones and flood zones are seeing significant increases in their insurance payment. Also, when we're calculating your debt to income, we aren't factoring expenses that you might have that aren't showing up on your credit report. You might have kids in college or going to a private school and you're paying their tuition. We don't see that. We don't see daycare expenses that you might have. Your credit report doesn't include expenses such as cell phone, utilities, groceries, gas, health insurance. You need to factor in all of these expenses when you're considering what you feel comfortable spending every month on housing payments. If you have an option to bring a co-borrower in on a loan, whether it be a spouse or a family member, to help in case your loan amount isn't what you're looking for, we can do that. But we would need to factor in not only their income, but also their debt as well. And a co-borrower would be just as liable in making the payments on the loan, even if they're not living in the property. They hold as much responsibility as you in this new mortgage will reflect on their credit report. So a co-borrower is definitely something we can discuss whenever we go over your pre-approval. Okay, as I mentioned, this video is to help give you a general idea of how to figure out what you can qualify for. A loan officer can help you narrow in on a loan amount and what you're pre-approved for, but final approval will be up to the lender. But feel free to reach out if you have any questions or are thinking about purchasing and want to know what loan amount you're pre-approved for. I'm happy to help. As always, if you found this video helpful, please be sure to like, share, and subscribe. Thank you for watching. I'll see you next week.